Hello everyone. We just have lots of people still joining, so we'll give us a minute or two and then we'll kick off. Okay, I think the numbers have started to stabilize there, so we'll start. Hello everyone. Welcome to this cross-practice session on the Consumer Insurance Contracts Act. My name is Gavin McGuire and I'm chair of the Life Reinsurance and Innovation Committee. Before we start, we just do a little bit of the usual housekeeping stuff. So the session will be recorded, including the Q&A, and we're hoping to post it on AccuView afterwards. We have a great panel and we're going to leave lots of time for Q&A towards the end. So please, you can submit your questions through the Q&A chat functionality, or alternatively, when we get to the Q&A point, use the raise your hand function and then we'll unmute you and you can ask your question directly. From a CPD perspective, once you've registered with your full name, you're considered signed in for the purpose of verifiable CPD. I think those are the main ones. I suppose if we kick off then in terms of the main content of what we're trying to cover today. So for, oh sorry, I missed the competency framework. Yeah, so from a society competency framework perspective, the topics today primarily focus on regulatory matters, industry issues and professionalism issues for us to all consider. So yeah, so on the Consumer Insurance Contract Act, so if you Google the Act, you get several media articles where it talks about the massive boost for consumers and small firms, and it's been described as a game changer by the Alliance for Insurance Reform. So I'm delighted to be joined by a panel of experts to guide us through this important topic and help us understand what this means for us as actuaries and our underwriting and claims colleagues. I know we have a few underwriters and claims assessors who have joined us for this session today, so a really special welcome to you guys. What the structure today was, each of our panel members will take a few minutes to present the key issues from their perspective, and then we'll launch into a Q&A. I suppose we have 4 main speakers to go through, and we're going to cover a broad range of topics in the time we have. So hopefully it'll be really informative for everyone. So I'll just introduce each of our speakers and then I'll pass across to them to kind of kick off the presentation. So firstly, we'll start with Naoise Harnett, who is a partner at Pinsent Masons and specializes in corporate insurance and reinsurance sector. He was previously a partner at William Fry. He has advised on a number of high-profile corporate insurance and reinsurance transactions in Ireland, and he combines his impressive track record in corporate insurance and reinsurance transaction work with a reinsurance insurance regulatory practice encompassing all areas of Solvency II and Irish financial services legislation and regulation. And Naoise is going to bring us through some of the aspects of the bill from a legal perspective. Following Naoise, to give us some insights from the practical issues that general insurers are facing, then we have Adrian Leonard, who is Technical and Risk Underwriting Manager at IPB Insurance. He graduated from the University of Limerick with a Bachelor of Science degree in Applied Physics. He's worked in non-life insurance for the last 15 years in a variety of different roles, including property and liability loss adjuster with Kunze Lindsay and a commercial underwriter in Allianz. He joined IPB 9 years ago, and he's currently responsible for pricing, contract documentation, product development, underwriting governance, and regulatory controls. After Adrian, to give us the life perspective, we've got Edel Connell, who's head of compliance for Irish Life Assurance and has responsibility for the compliance functions of the insurance and intermediary businesses within the Irish Life Group. With almost 25 years in experience in the life insurance industry, she's gained extensive knowledge of the Irish financial services environment, including its products, distribution channels, financial reporting, and its solvency regime. Her previous roles included insurance product development and financial reporting roles, and she was a program manager for Irish Life Solvency II implementation project. She's comprehensive understanding of the regulatory framework for the insurance companies, both conduct and prudential. She's qualified actuary and holds the Association of Compliance Officers Gold Medal qualifications, and it's also a Q&A. And then finally, we'll wrap up with Ciara O'Grady, who is the Director in the Risk Advisory, Regulatory and Conduct Risk Practice of Deloitte, where she provides regulatory compliance and conduct risk consulting services to a broad range of clients, including insurers, reinsurers, cover holders, brokers and credit institutions, investment management firms and other financial service providers. Ciara has experience working with financial service providers in managing upstream and downstream regulatory compliance and in identifying, assessment, managing and mitigating conduct risks. Most recently, Ciara has led a large-scale framework design and remediation programs for firms addressing CBI's expectations in the management of conduct risk, including the framework of fair customer treatment. So yeah, so Ciara will give us a little bit of views from the market overall and what she's seeing across the industry and across the CBI response. So lots of expertise there, lots of inputs. So again, I would encourage you as you go through, as you hear some of the presentations, to submit your questions through the Q&A, and we'll make that piece of the session as interactive as possible. So with that, I'll hand over to Naoise.
Good afternoon, everybody. Thanks for joining today. I think to start, it's important to understand the context in which the Consumer Insurance Contracts Act 2019 was enacted. It was initiated at bill stage as the Consumer Insurance Contracts Bill 2017 by Pierce Doherty, TD of Sinn Féin. And the express intention at that stage was to shift the balance in favour of policyholders by increasing transparency and strengthening the hand of the policyholder during the insurance contract. The bill ultimately received cross-party support and was enacted as the Consumer Insurance Contracts Act 2019 on the 26th of December 2019, although it wasn't immediately commenced. So I'd argue that it was difficult for the other political parties to resist the 2017 bill, given its stated aim and the political sensitivity surrounding the insurance industry and policyholder rights in Ireland at that time. There has been significant resistance to certain of the proposed changes in the 2019 Act from the insurance industry, and Insurance Ireland lobbied the Irish government vigorously for amendments to the 2017 bill, and then subsequent to the enactment of the 2019 Act, for delayed commencements to allow insurers prepare and make the necessary adjustments required to meet the challenges created by some of those changes. So this explains the delayed commencement of the Act and also the staggered approach to commencement, which was adopted in the recent commencement order. The approach adopted in the commencement order is that the non-controversial elements of the 2019 Act, which the insurance industry were not contesting so vigorously, have been commenced from 1 September 2020. The more controversial elements of the 2019 Act, which the insurance industry have been complaining about consistently, will not commence and have effect until the 1st of September 2021. Finally, it's important to state that the Act applies to life and non-life insurance, other than certain specific lines of non-life business. It applies to new contracts, variations or renewals after the respective commencement dates. The Act doesn't apply to reinsurance, although reinsurers will obviously be impacted to the extent that the 2019 Act alters claim settlement patterns of direct insurers carrying on business in the Irish market. So if we could go on to the next slide then, please. I propose running through some of the material alterations which arise under the 2019 Act and which have been commenced from 1 September 2021. I am not going to go into granular detail on these, though, as I'm conscious that my fellow speakers will also deal with some of these points later on in the presentation. So there are changes in the Act to the requirements that an insured must have an insurable interest in a contract of insurance, and this has garnered a lot of media commentary and attention. The approach adopted appears to set aside years of case law about the requirement for there to be an insurable interest in a valid contract of insurance. So from a lawyer's perspective, this is quite interesting. This was previously required as a matter of policy to avoid insurance contracts potentially becoming akin to gambling contracts. Under the terms of the Act, a claim under an otherwise valid contract of insurance may no longer be rejected on the basis of a consumer not having a valid interest in the subject matter of the contract at the time the contract was entered, or at the time of the loss. So a policyholder will still be required to demonstrate loss in order to make a valid claim. And the Act also acknowledges that a consumer may be required to have an interest in the subject matter of a contract of insurance where that insurance contract is an indemnity contract. However, a number of types of insurance are non-indemnity insurances where the amount of compensation cannot be directly correlated with a loss, obvious example being life insurance. The Irish approach in the 2019 Act is interesting on this point. By abolishing the requirement for insurable interest, we've moved away from the UK position, for example. A Law Commission review in the UK opted in recent years to retain the concept of insurable interest, but to specify in law some specific relevant examples where an insurable interest would be deemed to exist. So the option in the UK was to expand the concept of insurable interest rather than abolish it. The principle of utmost good faith will no longer apply to the post-contractual stage following 1 September 2020 for all contracts coming within the scope of the Act. The Act specifically includes limitations on alteration of risk clauses, so they should only apply in circumstances where the subject matter of the insurance contract has been altered to such a degree that the insurer can say that the new risk is something which on the true construction of the policy it did not agree to cover and didn't contemplate covering. While this provides clarity, it's a very high standard for the insurers to meet. The Act also provides in Section 16 that any statement by a consumer with respect to the existence of a state of affairs or a statement of opinion shall be treated as a representation by the consumer and shall not be treated as an insurance warranty, as is commonly the case currently. Warranties in insurance contract are terms or conditions which would permit a party to an insurance contract, and usually the insurer, to repudiate the contract and refuse to meet the claim if that warranty is breached. The Act also specifically calls out basis of contract clauses and other comparable clauses purporting to convert a representation into an insurance warranty as being invalid. Another point that's relevant from Section 19 is that any contractual term which imposes a continuing restrictive condition on a consumer, i.e. that they shouldn't be doing something, they shall be treated as a suspensive condition, in that upon a breach of such a condition, the insurer's liability is suspended for the duration of the breach. But if the breach has been remedied by the time a loss has occurred, the insurer shall be obliged to pay any claim made under the condition of insurance. So the contract doesn't fall away where one of those conditions is breached. It's only suspended for a period of time. Finally, there's an interesting provision in Section 16.3 of the Act which provides that where a consumer does not make a claim within a specified notification period, and this does not prejudice the insurer shall not be entitled to refuse liability under the claim on that ground alone. The insurer will instead be required to demonstrate prejudice as a result of the delayed notification. And I think this change is interesting as it's consistent with the other changes I've described and which are commenced on the 1st of September 2020, in that they are seeking to limit the insurer's ability to avoid claims on technical grounds where it has not been impacted or prejudiced. So this obviously benefits consumers, but the impact on the insurer needs to be assessed to determine if the correct balance has been struck. And that's ultimately something that's going to be borne out over time. So if we could jump onto the next slide, please. So looking now at some of the material changes introduced by the Act, but which have a delayed commencement of 1 September 2021. The first major change is in Section 8, and it is the removal of the principle of utmost good faith in the pre-contractual stage. The Act is attempting to ensure that the only pre-contract disclosure obligation on the consumer shall be to answer fully the questions posed to it by the insurer. And this places the responsibility on the insurer to frame the questions in a way that all the information it requires to underwrite the risk is extracted through those questions. If the insurer fails to do this, it bears the risk and the potential liability which arises. Another major change is set out in Section 14 of the Act, which details the information to be provided by an insurer at the renewal stage. The consumer will not be required to provide any additional information to an insurer at renewal stage unless the insurer specifically requests the consumer to do so. However, the insurer will be under an obligation to ask the consumer questions at renewal stage if it is seeking any further or updated information from the consumer. And finally, an area which has received major focus in relation to in this regard are the introduction of the concepts of innocent versus negligent versus fraudulent misrepresentation, and they're introduced by Section 9 of the Act. An innocent misrepresentation by a consumer will not permit the insurer to avoid paying a claim. There are a number of potential remedies available to an insurer in the event of a negligent misrepresentation, and they depend upon whether the insurer would have still entered the contract and whether the terms which it would have used in those circumstances would have been different or not. Where the response to the pre-contract inquiries involved fraudulent misrepresentation, the insurer can avoid the contract of insurance and the payment of the claim. But what this means is from the 1st of September 2021, To the extent these concepts aren't already brought into the practices of insurers already, insurers will be drawn into attempting to determine at claim stage what is an innocent versus a negligent versus a fraudulent misrepresentation in order to determine what remedies are available to it. If there's been a negligent misrepresentation, for example, the insurer will also need to determine what action it would have taken had the negligent misrepresentation been made correctly to it. So this is extremely onerous for insurers. A final point is that there's been a lot of commentary about the concept of fraudulent misrepresentation, and that it should have instead been reduced to a lower threshold of deliberate or reckless misrepresentation. And this was a standard which was adopted in the UK. So again, this is an area where we've diverged from the UK example. And the difficulty with fraudulent misrepresentation is that it suggests a threshold akin to a criminal standard in establishing a fraud, which would be too high for insurers to meet, and ultimately means they will be unlikely to rely on the remedies which are available to it for fraudulent misrepresentation. And then finally, for my last slide, if we could just move on. It's just to conclude with some final thoughts. I've tried not to get into too much detail regarding the various sections there and give the material legal issues which I feel are arising. But one of the big questions I would have in relation to the 2019 Act is whether the balance between improving policyholders' rights have been balanced against the increased burden on insurers. And that question as to whether that balance has been struck again is one which will probably be borne out over time, although we might all have our opinions on it now. I would argue that there's a significant chance that the cost of the increased burden on insurers and changes to claim settlement patterns will be passed on to policyholders. A significant point not to be overlooked is the impact on reinsurers, which may have reinsured a book of business on the basis of claim settlement patterns, which may now be altered. This may result in higher reinsurance premiums, which will have to be borne by the direct insurers, and again, potentially passed on to the ultimate policyholder. Finally, we've chosen a different route to the UK on two key issues: the abolition of the concept of insurable interests, and also the introduction of fraudulent misrepresentation thresholds. It remains to be seen whether this Irish approach was ultimately the correct one. So now I'll pass you over to Adrian Leonard, who's going to look at some of the non-life insurance impacts of the Act.
Thank you very much, Naoise. Hope you can all hear me fine here today, and thank you for the opportunity for running through our experience in IPB with regards to this particular piece of legislation. IPB don't currently underwrite an awful amount of consumer contracts, but we do actually have a wide variety of different products. And as Naoise suggested there, in terms of the cost of compliance and the effort involved in compliance, is effectively the same, irrespective of the number of actual policies or number of premium written. And we certainly found many of the vagaries of the legislation a challenge in order to interpret and to reflect that in our contract documentation in particular. So just if you move on to the next slide. So just to give a quick couple of notes in terms of some of the impacts on non-life insurance. So it impacts all products apart from marine from a non-life perspective. And although the Act itself applies to consumers, so that's individuals and also any commercial entities with a turnover of 3 million or less, in reality, for practical and logistical reasons, this impact from a documentation point of view in particular is going to be applied to a much wider variety of customer. And that's because most insurers will find it a challenge to have parallel processes in place in relation to consumers and non-consumers. And from an IT and a systems point of view, it can be very challenging to have two different processes and two different IT systems in play. In addition to that, you have certain customers that may change their consumer status midterm or from one year to another, and you're flipping forwards and backwards between different policy documentation. So for logistical reasons and practical reasons, this in effect will apply to a much broader category of customer than just consumers. The other thing about this Act is, and I think it's relatively unusual that they've called this out, that not only this, the impact of this legislation will impact any contracts midterm. So once you make a alteration to a contract midterm on or after the 1st of September, this new legislation will come into play. So what that also means is that there will be contracts out there that will be written based on the old legislation, and mid-term, before insurers have had a chance to update those documents and reissue those policy wordings, this new legislation will come into effect. So the legislation will in fact override whatever contract documentation is already out there. So moving on to the next slide on insurable interest. Yeah, so as Naoise says, what the Act is doing is abolishing the concept of insurable interest, and from a contract of indemnity perspective, which is what most non-life insurance contracts are, the claimant need only show that they had a financial interest in the subject matter at the time of the loss, and not necessarily at the inception of the contract. So some practical issues there would be whether this will increase the likelihood of fraud. Possibly not so much in a non-life insurance perspective, because they still have to show a financial interest in the property at the time of loss. So maybe it's not as much a concern in relation to non-life insurance, but there are practical implications in terms of GDPR and whatnot, where you have a contract with a particular individual and you have someone who's external to that contract also seeking indemnification under a particular policy to which you have no contractual relationship with. So even sharing of information, even sharing the existence of what policy coverage is there with such a party is one practical issue that remains to be seen how it would be dealt with. Moving on to the next slide. In terms of Section 14, duties of consumers and renewals and insurers at renewal. So currently under existing legislation, insurers have to provide notification of their intention to renew policies within 20 days of renewal. So that means you have to give customers in writing notification that you intend on renewing. You don't necessarily have to provide them with all their policy terms and conditions at that stage. But however, from the 1st of September 2020, you must also provide details of their terms and conditions within 20 days. And any alteration to those within 20 days. So some practical issues that may arise there is what happens if there is material information that comes to light within the 20 days, say if there was a particular flooding event which happened within the 20 days, or indeed some other sort of information came to light. Have insurers any ability or right there to modify those policy terms and conditions within those 20 days? Based on the legislation, it would suggest we would not have the ability to do that. Moving on to the next slide. In relation to Section 15, alteration of risk. So again, this is in relation to notifying changes of the risk midterm to contracts. So if there's been a change in the risk midterm, currently there is a duty on insurers or on customers to tell insurers of any of those material changes. What has changed now is that has been a softening of the language, and only changes to the risk which are within the reasonable contemplation of the contracting parties when the contract was affected now need to be notified. So in order to reject a claim due to a change in risk, it would have to be a very significant change. I think the language used there is would have resulted in the insurer not writing the risk or applying substantially different terms and conditions. So one area of dispute there is what is a substantially different term and condition. For example, on non-life property policies, many insurers would give some kind of small discounts in relation to alarms, fire alarms, things like that. And in the absence of those things applying or being changed midterm, it remains to be seen whether that would be deemed substantial enough in order to avoid payment of a claim or reduction of a claim. So I can see plenty of potential for dispute in relation to that item. On to the next slide. Claims handlings and duty of consumers and insurers. So this is a relatively substantial change, and certainly from a non-life perspective, there's been lots of representations made through Insurance Ireland and separately by insurers to the Department of Finance with regards to this particular provision of the Act. In addition, I'm also aware that the Law Society also wrote some strong views in relation to this particular item of the Act. One suggestion is that this is potentially unconstitutional, because what it seems to suggest is saying that legal advice in relation provided either to a claimant or to an insurer in relation to a potential area of conflict must now be shared between the various parties. So the sharing of legally privileged information is something that many would consider to be a fundamental right on various parties, but it would now suggest that right at a minimum has been some way adapted, if not removed. Another practical example is if you're investigating a claimant for fraud, how do you do that without tipping someone off and sharing things like private investigator reports and things like that? So I'm not sure how the practicalities of this issue is going to be resolved. It was one that insurers had strongly requested that the minister postpone the commencement of this particular section until it's resolved. But as it is, this particular piece of legislation has now commenced, and I can see this being a matter for the courts to resolve at some stage. On to the next slide. In relation to deferred payments, so this is very much a property-specific issue, and some of you may know that when a substantial property claim is settled, for example, say if there was a significant fire damage claim, an insurer generally wouldn't pay out 100% of the agreed settlement amount. They would usually retain an element of the settlement back pending completion of the works and evidence that all the expenditure has been incurred. So usually I think the market practice has been to kind of retain back at least the VAT element of it, but it could be up as far as 25%. From the 1st of September 2020, while insurers still have some ability to do this, the amount that you can retain will be, depending on this amount of settlement, somewhere between 5% or 10%, depending on the claim settlement amount. One concern there is, will it encourage fraud? Because it encourages claimants to potentially exaggerate losses in the safe knowledge that they will get almost 100% of the settlement amount up front, rather than having to prove expenditure. The other suggestion there is when claims are adjusted for these types of losses, obviously things like VAT and whatnot are included in the settlement amount. But now that the retention amount being held by insurers is less than the VAT, it would certainly encourage some individuals to use non-registered contractors and therefore keep the balance of the claim settlement for themselves. Moving on to the next slide. So warranties, basis of contract clauses and conditions precedent to liability. So these are relatively kind of strict aspects of policy wordings, and insurers would generally apply this for some particularly strong aspect of a risk that needs to be either put in place, such as a fire alarm or something of that nature. What's happening now in relation to the Act is that conditions precedent to liability and warranties are now reduced down to bare conditions. So what that means is, depending on the materiality of the breach, insurers can then either decline a claim or reduce the amount of the settlement of a claim to reflect what would have happened had the condition been complied with. So in some ways, this definitely is very beneficial for the consumers, but from an insurer's perspective, it will likely result in more protracted and complicated coverage disputes, because now, rather than looking at whether or not a condition is complied with or not complied with, we will now have to take a view in terms of if the customer had complied with that condition, what would have happened and what would be the extent of damage had the condition been complied with. And arguments like that are quite complicated in nature and very subjective in many cases. Moving on to the next slide. One other big change, and it somewhat aligns us with the UK in relation to this aspect, is that there is now rights conferred on third parties which relate to policies of insurance for legal liability, such as public liability or employer's liability, prior to the 1st of September 2020, a claimant would not have a right of access against an insurer for public liability or employer's liability. They would have to claim directly off the policyholder, who would then trigger their policy. However, from the 1st of September 2020, if the policyholder is either deceased or insolvent, or for whatever other reason, a third party can now have a direct right of access against the insurer, and the insurer has to engage directly with that third party. In addition to that, the insurer also has a duty to provide the third party with high-level information in terms of what coverage is in place, including things like limits of indemnities, policy excesses, and any conditions which may apply. So one practical issue there is if you were an insurer for a policyholder who was deemed insolvent prior to the 1st of September this year, you could safely assume that there would be no new claims in relation to that policy. And now third parties have a right of access to claim against the insurer directly in relation to such contracts. Moving on to the next slide. In relation to Section 12, renewal of contracts of insurance. So this is something that's going to come into effect in 1st of September 2021. And what insurers are required to do now is provide a 5-year claims history in relation to the premiums paid and claims paid in the preceding 5 years. One practical issue that some insurers are having is being able to extract this information from legacy systems. In addition to this, the Act also requires insurers to provide annualized versions of those premiums, so taking into account any midterm alterations which may have happened or any short period policies. And I think many insurers have expressed the view that they're going to have particular problems in terms of extracting this data from certain systems. In addition, the legislation is not clear what it means by claims paid in the previous 5 years. On one reading of it, you would think they're asking you for information with relating to the 5 previous underwriting years, but in fact the legislation just says claims paid in the previous 5 years, so it could be payments made anytime in the 5 years, but relating to any other prior underwriting year. So it could be, you're kind of getting a bit of a mismatch between what is in the premium side of the column and the claims payment side of the column, which I think is an unintended consequence of this. So I think various insurers will have to make various judgment calls in terms of how to present this information in this new document. On to the next slide. And I think, as Naoise mentioned as well in relation to this issue, this is definitely a major issue for commercial insurers. So what this is doing is it's removing the duty of disclosure at renewal and puts a requirement on insurers to either ask specific questions or else provide the information that was previously provided that the insurer intends on continuing to rely on. So one major challenge in relation to this is that, particularly in relation to commercial insurance contracts, a lot of the information isn't stored in a system which is easily to create a documentation or a statement of fact type document. For example, if an insurer carries out a survey of a risk or asks various follow-up risk questions by email to the broker or directly to the client, and that information comes back in, then the insurer would rely on that information going forward and would rely on the duty of disclosure for customers to tell them if something had changed. So that seems to be essentially gone out the window, whereas now insurers are going to have to find a way of capturing key information in such a way that they're able to regurgitate that information back out at each renewal and ask the customer or the consumer to attest that that information is still up to date. So how insurers are going to do that is going to be a major IT challenge. I think in some cases, insurers will end up risk accepting the fact that there's going to be changes to risk, that they weren't able to revalidate that information at each renewal. And that may be something they'll have to risk accept in some cases, pending having fully fledged IT systems that both capture this information and is able to regurgitate this information out in terms of statement of fact type documents. And moving on to the next slide, I think that is it. So Thank you very much. And I'm going to pass over now to Edel, who's going to give some views in relation to the life insurance practical implications.
Hi, thanks, Adrian. We might go straight into my first slide. I think as you read through the Act, it's quite clear that the politicians did have the non-life insurers squarely in their sights when they were drafting a lot of the requirements of the Act. But they do apply equally to life insurance contracts, and obviously your protection ones mainly. And in general, it's obviously a big advantage for the life insurers that our contracts are long-term. We don't have this concept of renewals, which creates extra difficulties. But there are some practical challenges that the long-term nature of our contracts could potentially cause in the future, which I will cover. Thinking about reinsurers, as Naoise said, they aren't covered directly, but obviously they will need to consider the implications in terms of changes. And again, I'll talk about how the life offices and the reinsurers might need to discuss future claims practices as they go through. I think if you look at what was considered, I suppose, the most substantial piece of the Act, which was the idea about making it more difficult for insurers to fully void a contract where there had been a minor non-disclosure, let's say. I think regulation has been moving that way, and industry practice has been moving that way over quite a number of years. The Consumer Protection Code was obviously pushing insurers to act in the best interest of customers. And when declined cases were going to the Financial Services and Pensions Ombudsman, because he wasn't constrained by the law as such, was definitely looking at what was fair and thinking about what was the extent of the non-disclosure, what impact did it have. And that's really fed through, I think, into lots of life insurers' current practices. But there's quite a difference between having best practice when, if you're unsure about how to prove something, you can rely on your strict terms, and really having it codified that you're going to have to be able to classify any non-disclosure into one of these three categories before you can decide what to do. If we move on then to the next slide, there's one small anomaly that was very specific to life insurance, which did catch us during the consultation period. The initial suggestion in the Act was that there'd be a 14-day cooling off period across all products with a blanket requirement to return premiums. Now, obviously, the life insurers were somewhat concerned about their single premium policies, where obviously today under Solvency II, you can deduct any fall in investment markets, because obviously otherwise you'd be very substantially exposed if you're to invest substantial sums in the market and potentially have to make good any falls that arose quite early. The final Act does attempt to allow for this, in that it does say that if a policy is entitled or is granted cooling off rights under Solvency II or the Distance Marketing Directive, that those existing rules apply, which would allow the deduction of falls. But of course, when you read through into the details, insurers realised that Solvency II in particular covers individual life insurance policies. And what do that mean for group contracts, say bulk PRBs purchased by trustees, for example, where you mightn't normally have said that it fell into that category, but clearly the risk is there. Insurers are definitely looking at different ways of dealing with this, whether it's to actually grant all customers cooling off rights, or to consider, I suppose, what is meant by the financial cost that you can't impose, and whether that covers investment losses. But it's certainly clear, I think, as you read through the Act, that there are some quirks in the wording that the more you look into it, the more problems you can sometimes consider might exist. We move on then to the practical issues. And this is really just about the actions that the projects in the different life offices, I'm sure in some form, are all going to cover. Application forms are obviously a big one. Depending on how broad your product range is, there can be an awful lot of protection application forms doing the rounds, and they all need to be reviewed, this one luckily before September 2021, to ensure that the relevant information is really specifically requested and using what they call plain and intelligible language. Now, the CPC has asked us to use plain English for a number of years, but if you're in the position that any issue with the questions will be found in favour of the customer, it is causing us to look at those again. The other piece, as Adrian had said, the issue about having to give back to the customer the information on the application form. Whilst you may actually give back, and lots of life insurers certainly give their customers a record of what was on the original application form, where do you stop in terms of any extra information that may be gathered during the underwriting process? You know, whether that's from the customer, from their GP, from an independent medical report. So there's a bit of work to be done to determine exactly what the scope of that requirement is. Terms and conditions, then again, more documentation work to be done. I think it's definitely the case that some of the requirements will be brought in as a matter of best practice immediately. Say, for example, the right sort of third parties, but the work to go through all the contracts and make sure that all of your paperwork and your practice actually align is quite a big one for insurers over the coming months. Quality checking is another interesting one that that came up when it came to application forms. The Act says that if there's a missing answer in your underwriting questions or an obviously incorrect one, the insurer has the responsibility to follow up on that, or else they waive their right to rely on it when it comes to a question of non-disclosure at claims time. And that can really up the ante. You know, a missing answer, you might be able to pick up in an automated fashion. But the obviously incorrect, I think, is one that could be open to challenge at a later stage and may make us think whether for, you know, larger risks, we may move away from automated checking and may look at kind of more individual checking just to see if there's any issues that that could be missed. Group contracts, obviously, I've covered about cooling off rights. And then if we just head on to what's my final slide, claims processes again. So, you know, the life insurers in particular have definitely largely moved, I would say, in practice to the idea of different categories of non-disclosure leading to different outcomes. So the most typical one on the life assurance side would be a wrong date of birth. We don't overly check it at the point of underwriting. If an incorrect date of birth is discovered at the claim stage, quite simply the sum assured is adjusted in order to reflect the correct date of birth. There's no question of going any further with that. I think that's practice across the market. But all our paperwork and potentially some of our documented internal processes do still talk about the right of a full revocation of the policy if there's non-disclosure. So there is a bit of work about aligning documentation and practice in that area. And I do think, again, as the other speakers have said, the fact that if you do want to kind of fully cancel a contract from outset, that you have to say that it was fraudulent. I certainly think for non-disclosure issues, it would be exceptionally rare for the guards, for example, to be involved in the same way you would on a clearer financial fraud. But potentially in using that language in the Act, it is going to the stage of suggesting that you know, a report to the guards would be required as part of your processes if you wanted to claim fraudulent non-disclosure at claims time. Similarly, some changes, I think, whilst Adrian covered it on the non-life side, particularly for income protection claims, obviously the right of third parties to claim against the contract would have some potential impacts that will need to be looked at. And then the other one, as I was saying, in general, long-term contracts are an advantage when it comes to the Act. But one that's going to need to be looked at, I think, is the claims process and the interaction with reinsurers when it comes to contracts that have been written, 1, 5 or 20 years in the past. If the move to categorize claims in different ways does lead you to have a change in your claims practices. Obviously, legally, it only applies to new contracts entered into from the 1st of September 2021. But in practice, by the time we get, 2, 5, definitely 10 years down the line, insurers won't want to operate two different claims philosophies depending on the date of inception. And whilst you may decide to do that yourself and sort of be willing to take on the cost of the risk you've retained, you obviously need to re-engage with your reinsurer, because potentially, depending on how impactful this was, they may be more likely to stick to the letter of your agreement with them and only be willing to pay what they're legally required to pay. Whereas you may feel that in order to maintain your reputation in the market, you have had to move to something that's more aligned with the requirements under the Act implemented this year. So I'm sure we'll get into more as we get into the Q&A, but I might just now hand over to Ciara just to talk about her view across the wider market.
Thanks, Edel. So hi everyone, good to speak to you this afternoon. So I'm going to spend the next 5 to 8 minutes giving you an overview as to where the market's at in terms of their compliance with the legislative provisions, both for 1 September compliance for 2020 and 2021. I think the guys have gone through enough detail around the provisions of the impacts of the Act, but I thought it might be worth talking about some of the more contentious provisions and where the impact is being felt within the market. And then I'd like to talk through some key events that are probably going to happen over the next year that will require some flexibility in implementation programs and ones to watch out for. So we might just go through to the slide. Luckily, I just have one slide, keep it short and sweet. So I suppose to begin with, I thought it'd be interesting to share a quote from one of our Deloitte CRO clients, where he described the impact on his business as requiring a far more deliberate and considered approach to how they will manage customer interaction during all customer touch points in the insurance life cycle. I thought that was quite a succinct way of describing the impact of the business on their business, and certainly goes to the heart of the intention of the Act. It's not without its pain points, however, certainly from an industry perspective, given the onerous obligations that are being imposed on industry participants. So there certainly has been challenge to 1 September 2020 compliance, albeit that, they're probably the less contentious areas. There's been a number of contributing factors that are still presenting challenges to meeting the requirements. So if you think about what is the general practice in meeting upstream or incoming regulations, it requires firms to identify what's the impact across the people, systems, processes, governance, from a customer perspective and a documentation perspective. It requires you to gather all of the impacted business individuals across the business from first and second lines of defense. It requires you to take that impact and actually do an assessment of where are we today versus what are the changes that need to be put in place. And then business requirements redrafted, particularly around systems or documentation, communication out to your customer, and then embedding through training and awareness. And so with that in mind, the delay in the commencement order, many firms felt that the 1 September deadline had crept up on them. And in order to properly assess your impact and keep and the changes required, and to keep a robust audit trail for the regulator, the compliance timeline has been felt to be very tight. It requires input from an awful lot of stakeholders across the business, across various different disciplines: compliance, legal, claims, risk, underwriting, DUG, and sometimes across jurisdictions where you have those support functions supporting your Irish business and your Irish customers. And so in a remote environment, because the way we're working at the moment, this has been very challenging. Those same individuals are probably being subject to a lot of regulatory requests and a lot of competing regulatory priorities from regulators locally and overseas. And so it really has presented challenges to implementation. Certainly with the commencement order and the phased implementation approach, that has been welcomed. I suppose what it allows is, you know, a far less tactical, more strategic approach to the 1 September 21 timeline. And I suppose our advice to our clients is to take advantage of that lead-in time to try and, or to use that time to get input from various stakeholders, to take a more strategic and data-led approach based on historic claims information, how you're dealing with your customers in the past, to ensure that you're optimizing what you put in place going forward. You will also need that time because there are a number of key steps that will happen over the next year, and you know, how your interaction with your customer evolves. That will require you to keep your implementation program flexible. So I think across the life and non-life sector, and with Naoise's technical update, we have discussed in detail where the impacts are being felt across the different sectors. For me, one of the biggest contentious pieces was certainly the definition of the consumer. There was obviously impact or pushback from the industry to keep it in to individuals dealing outside their trade or employment. But the legislature, where they landed, was entities with less than a 3 million turnover, in line with the CPC definition, would be kept. I suppose this is down to the perception by the legislator that for entities of that size, so the non-consumer elements within that scope, that would be retained on the basis that many involved in the purchasing decisions for those organisations would not be sufficiently sophisticated, and therefore, in the eyes of the legislator, warranted the same protections as an individual customer. So staying true to the CPC definition. I suppose the reason I mentioned this is it's definitely aligned to international regulators' views, where the FCA has been proactive on commercial lines and wholesale insurance conduct risk issues. This is often a focus area of theirs. And to balance the information asymmetries, it is a point that they often push. And so I think that probably stays true to the legislator's approach from an Irish perspective. The reason I bring it up also is in dealing with many international firms, while they may have, for the 1 September 2020 timeline, been able to leverage processes that were enhanced where they have books of consumer business in the UK, and been able to leverage some of their contractual changes, that they made under the UK legislation, many of those international firms still today grapple with the difficulty of the non-individual component of the consumer definition. And so in the absence of being able to very clearly within your systems cohort those customers, I think the 1 September 20 challenge will continue to be difficult to the 1 September 2021. So much of Adrian's points around, you know, the transient nature of a customer being a consumer or not is definitely felt across sectors, and predominantly in international insurers, where they write for both Irish customers and EU customers across member states. I think it definitely warrants a look at by the European Commissioner from a practical perspective to have a joined up European definition of the consumer business and the protections that warrant across member states. And so I might just take a few moments to talk about, from a practical perspective, where are firms now on their compliance journey for 1 September 2021. And just to remind you, those are the pre-contractual duties of disclosure, the renewal rights obligations, and the misrepresentation determination through the claims process. And like my fellow panelists had mentioned, these are the more onerous pieces of work. And so across various organizations, both internationally and the local insurers, working groups of different scale have been either established, or for now, to take more of a strategic approach to implementation, are being set up. Program sponsors are being identified either within compliance, legal, or claims predominantly. And there's definitely engagement across the 3 lines of defense. The implementation process that we have seen that work well divides the piece of work across work streams. I think I had mentioned at the outset, impact assessments across people, processes, technology, training and governance will allow you to discount those provisions that won't be applicable to you, concentrate your efforts on the high priority pieces and enable you to plan kind of appropriately. Technology pieces probably being the biggest uplift, and some of your policy wording provisions and some of the claims process enhancements. I think there's an important piece here around the gap analysis against the legislative requirements. We've seen the CBI across Solvency II, MiFID II and CRD. Some of those large-scale implementation programs ask for your audit trail of how you interpreted certain provisions, the important ones here being around your misrepresentation and insurable interest and third-party rights. How you rationalize those? Did you get legal opinion? How did you get stakeholders internally on board? So keeping a good audit trail of those decisions and ensuring that you're mapping each obligation under the law to an enhancement in process of whether you comply today. I think a couple of different pieces of legislation have the potential to overlap in terms of process with the provisions of this act, and so important ones to capture. Distance marketing regs, some of the cooling off provisions in Solvency II. There was mention of GDPR and some of the CPC provisions. So where you have processes that are in place to meet those legislative provisions, you need to anticipate where there may be potential overlap and understand how you're going to prioritize one over the other and potentially comply with both. For the proposal form review, those who will take a strategic approach will make sure it's data-led. Where their systems aren't so legacy that they allow them to run some analytics on some of their previous claims data, some of their previous complaints data, some of the FSO decisions in relation to the duty, the disclosure duties. I think that will have to ensure that your proposal forms are tailored to your business, to your customer type based on historic information, and put you in the best position to be able to argue the fact thereafter. Policy wording updates will be a big piece, and legal and potential external counsel will be important to be on board throughout your implementation program. And I think we've talked about the claims process. Some of the trickier provisions the other panelists mentioned will be assessing misrepresentation, interpreting what your firm, how your firm will do so, and putting an appropriate process in place, and also settlement of third-party rights to the contract. Important to ensure that there's sufficient time before 1 September 21 to train your claims people and ensure that they're equipped with all the knowledge they need to do to take on these onerous obligations. And then we have seen some of our insurers contact already their cover holders and brokers to engage with them on some of the customer comms piece. So just lastly, before I finish up, I thought it was worth, we can't really have a conversation about legislative requirements in the insurance market without talking about one of our key stakeholders, the Central Bank of Ireland, who is the competent authority in Ireland for supervising compliance with this code. And so they would have expectations in terms of firms' readiness, not just for September 21, but also September 2020. So, questions may be coming up already in terms of how ready you are and what your plans are in place for meeting the 2021 timeline. Consumer protection, customer outcomes and fair treatment of the customer is at the highest priority within the Central Bank of Ireland at the moment, particularly in respect of the insurance sector. And so they will be looking at this very closely. We haven't had publication of what their views are in terms of this code, in terms of this act. However, they are provided with the right under the Act to publish a code, and we expect that they will do so. I suspect that that code will be a mixture of principles-based and prescription. Prescription in terms of how to meet the obligations under misrep, duty of disclosure, but there'll also be principles which will be a lot of narrative around outcome testing for the consumer, the role of risk and compliance, and keeping on top of the consumer outcome questions. And so we should probably expect an RTS type code, which will address some of the obligations under the Act, and then some principles that are, dotted across our principles-based codes like the CCMA or the CPC for insurers. So they're an important stakeholder in this process. Throughout this year, they will probably be publishing a consultation paper on the code. I suspect that that will likely coincide with their revisions to the CPC. It would make sense to do that together. We don't have an idea of the timelines yet, but you will need to make sure that you allow flexibility in your implementation programs for when that prescription does come in. I think this is often a difficulty when you're preparing for readiness for upstream regulatory change. Usually you get the level 1 directive regulation or act of parliament, and then you get the how-to months later, and sometimes not in sufficient time to meet the 21 deadline. So it is important to make sure that you build the flexibility in. So I suppose I also have mentioned some penalties here. Rather than talk about the stick to beat you with, I think it'd be good to move on to some of the Q&As around that. So just to summarize, still challenges to 1 September 2020 compliance, and many firms are not there yet. But as you work through your implementation, make sure you have a good audit trail of some of your key decisions. Try as much as you can to use the next 12 months to take a strategic approach to 2021 compliance. You will probably need it. Look out for the CBI code, and if not, some of the penalties summarised. So I might just pass back to yourself, Gavin, to run the Q&A.
Thanks, Ciara, and thanks everyone for those presentations. I think they're really, really good. We've had a good few questions in on the Q&A, but there's still time to send in some more. If you want to type in the Q&A, or else use the raise your hand icon, and we can unmute you and let you ask your question directly. Suppose to kick off with the first question, I think it's probably to Naoise in terms of the first question. There's probably two questions here we could answer maybe together. So there was a question about the intention behind removing the insurable interest requirement, and then also how does the insurable interest utmost good faith approach compare to other EU countries rather than UK and Ireland?
Okay, thanks, Gavin. Yeah, happy to take that one. I think the feeling regarding the concept of insurable interest, and the Law Reform Commission would have looked at this when it was reviewing consumer insurance contracts generally, and the same process would have happened in the UK when they were doing their similar review as well. The fear is that, again, an insurer may be able to technically avoid a contract by arguing somebody doesn't have an insurable interest, and it gives an ability based on case law over hundreds of years, basically, to find procedural reasons not to make payout on a valid claim. I suppose the difficulty with taking it out and taking away that hurdle is some of the principles which have been built up over time as to when an insurable interest is present fall away overnight. And I think the option that was discussed by the Law Reform Commission in Ireland, and also in the UK, was if you abolish the requirement for an insurable interest, should you then instead codify or define what constitutes an insurable interest in the legislation, and potentially provide hard examples of what would be a valid insurable interest. And that's what hasn't been done in the 2019 Act. So we're in a bit of a lacuna, I suppose, for some contracts as to what constitutes, an element of what would otherwise have been required to be a valid insurance contract. So you still have to show loss according to the 2019 Act. What does that mean? What level of loss? Also, for indemnity contracts, there's a recognition that you will need to have an insurable interest, but for life contracts or other non-indemnity type contracts, that isn't the case. So there's a bit of a grey area there for those contracts. I think in terms of the other EU jurisdictions, the insurable interest concept is largely an Irish and UK species, and that stems from our common law legal system as distinct from the civil law system in the EU, for example. I'm guessing that a lot of those other those other jurisdictions would have codified similar requirements within their statute, but Ireland and the UK, it was a based on common law principles established over years through case law. So it's a bit of an Irish and UK concept, and a species of our systems, I suppose, as opposed to the others. So I hope that's answered that question.
Excellent, thanks, Naoise. I think, Edel, there's a very specific question on what that insurable interest change means for life insurers. So if you want to pick that one up.
And I think it's probably worth pointing out that this specific requirement is really about insurable interest at the point of claim. And strictly speaking, I don't think the life insurers today actually worry about that at the point of claim. We do have the right to carry out checks at the point of application. And certainly today, where you have a different person paying the premium than the life assured, under anti-money laundering requirements, you generally establish the relationship, and potentially if it's not easily understandable, you know, it's not a partner, a spouse, a parent, there may be cause for question, because as you say, it is one where if random person A pays the premium on the life of random person B, and random person B then dies in mysterious circumstances, clearly you might consider the issues. But where there's no obvious relationship, and if there was a concern because of the background of either of the parties, I think you would actually deal with it under your anti-money laundering obligations and potentially report it to the guards as a suspicious transaction report. But it'll make little practical difference, I'd say, at the final claim stage.
Yeah, so then a follow-up question, just there's a few questions around what constitutes part of the application, and I think you referenced this in your presentation as well, Edel. Like, so one area of debate for our company was supplementary medical information such as questionnaires. So have you any views on that?
It's funny, I think it's definitely an area that all firms are grappling with. And I suppose in talking about it internally, I come back to what is the intention of the requirement. So the clear intention is that a customer could not, due to a momentary absence of mind, just put something on the application form. They don't realize that's what they said. And it's only when it comes to a claim that they look at that and say, oh my goodness, I never realized that. And that's why I think quite a few firms today have built up the practice of sending back the original application form and asking the customer, are they happy that sort of what they've said is really what they meant, just to give them a chance to confirm it. So if you think about the supplementary information that you gather, you probably have to think, how material would that be in terms of the non-disclosure? Because practically for quite a lot of things, you'd say the fact that the customer said, yes, I'm on medication for diabetes, is probably far more relevant than the specific details of the information that they give in terms of the chance that they'd, if you say you're on medication, it's less likely that you'll then, provide incorrect information that's so materially different it would make a difference at claim stage. So you possibly need to consider the relevance of each piece of information in deciding what you are going to return to the customer to give them a chance to review. Because I do think it's a very grey area, so you just have to be pragmatic.
It's likely to be a big challenge in terms of what's reasonable versus what's relevant, isn't it? The big one. So now, Adrian, from your perspective on the general insurance side, is there similar challenges?
Yeah. So just to mention, there's actually two separate issues here. I suppose the first one is the requirement you have to provide them with a copy of their completed application form. So that's really what indicates it's a new business type process. So certainly from a personal lines point of view, I think it's a much more straightforward thing to do, because I think most companies either have very clear sets of underwriting questions, a very concise set of underwriting questions, and that information is kind of stored in a way that's easily to give back to the customer, be it a copy of the actual physical proposal, or a copy of a proposal form, or a statement of fact type document. On the commercial side of things, trying to give a copy of a completed application form, it can be very challenging, because in some cases there may not be a completed application form. For example, some commercial new business would be transacted on the basis of a broker submission. So in this scenario, a broker would write up all the various details regarding a particular risk and would circulate it to multiple insurers. And on the basis of that document, insurers would quote the risk and they would be relying on that document. So in that case, there isn't even a completed application form to give back. And the other challenge then for commercial stuff is that you can't usually fit everything neatly onto a single application form. You may have various follow-up questions. Again, from a property perspective, say it could be around alarms. From a public liability, it could be around, you know, the nature of work that they're carrying out, you know, off-site and things like that. And you just cannot get everything neatly wrapped up into an application form. So how do you give back something that hasn't been given to you, and certainly not in a single document? So that's a challenge I think non-life insurers are grappling with. The second element then is the renewal process, where you have to once again ask them to reattest that the information previously provided is still up to date. And again, there could be changes to the contract midterm, there could be new information provided, there could be new locations added to the risk. So how do you give that information back at renewal stage rather than to revalidate that information at renewal stage? So that's that particular one is a challenge for 2021.
Absolutely. Ciara, there's a question there around cross borders and the extent to which it applies to cross borders, and I suspect they might be even a little bit behind the curve in terms of some of the challenges that we're talking about here. Do you want to comment on that one?
Yeah, absolutely. So to me, the territorial scope is pretty clear. The intention behind this act is to protect any Irish-based consumers. So those writing business from overseas would need to comply with these obligations for any policies that are issued towards Irish consumers. I mean, for those insurers, firstly, they need to have the processes in place to have identified the impact of the act. So the fact that it was coming down the line, I suspect for many of them, you know, the commencement order would have taken them by surprise. For those who do not have UK policy holders, many of these will be new concepts to them. So there will be an impact from an implementation perspective there. And also, you know, many of them wouldn't have high quality CPC compliance levels as well. So, you know, in looking at enhancing some of their underlying processes on the back of this act, there might be an opportunity to coordinate with some of the CPC enhancements too.
Cool, thank you. Okay. We've had a couple of different questions around the definition of consumer and whether group risk and group pensions and all those things are included. So maybe Edel, do you want to give a quick view on whether group risk and group pensions, and then Adrian, I might ask you a similar question.
I think the issue, I suppose, is if you look at it's the entity with the turnover of less than 3 million. Trustees are mentioned, and then the question is, where do you think about turnover? I think in general it's more straightforward on the life side to assume that they are in scope, because particularly if you think about group risk, the individual members will, and certainly on the IP side, do take claims to the FSPO, and he will definitely look to the Act in terms of how customers have been treated, I would say, in determining what happens. And then on the group pension side, there's less of an issue, obviously, a slight one about cooling off, but the advantage of pensions is, given that you can't get your hands back on the money, you know, cooling off is less of an issue there. So I think, given that on the risk side, the type of activities that they are talking about kind of has become better practice. I think my own view, I would say, is that market pressure is going to push people to include group policies, even if there's a question about the Act specifically requiring it.
It sounds again like there's lots of practicality difficulties there in terms of, do you want multiple processes, and, you know, how do you identify what the turnover is in each one? Yes.
Exactly. Which is why, you know, the same issue applies with the Consumer Protection Code today, and whether, you know, those requirements apply. And certainly for us in Irish Life, we've just taken the practical view. It would be too much effort to try and divide up your customers into the two categories. So just apply it across all.
And Adrian, sort of similar question to yourself in terms of classifying customers from commercial to individual, and where do you draw the line?
Yeah, like as Edel said, this I guess isn't a new concept. It's been in since the Consumer Protection Code, 2012 Consumer Protection Code, in terms of the 3 million turnover issue. In addition, the matter was kind of complicated even more by the Insurance Distribution Directive, which came in a couple of years ago, which came up with a completely different definition of what an IDD customer is, based on balance sheets and net income and all the other variables. So, and many of those things overlapped with the CPC, and now we have the CICA legislation coming back with the 3 million turnover back in. I suppose in reality, I think almost all insurers in the Irish market, particularly when dealing with the more kind of wholesale type products, will just classify them all as consumers for the purposes of the documentation and their processes. It's just too cumbersome trying to pick between the weeds. And if in doubt, it's always safer from a regulatory and an operational risk point of view to classify them as a consumer. So in IPB, we would cast a kind of wider net, much higher than 3 million in terms of how we would treat customers as consumers. I think typically then what insurers will do then, they'll know their large clients, they'll know their bespoke contracts, and they may have a different way of dealing with those ones. But I think for most kind of wholesale package type policy, commercial combined type policies, they will all be treated as consumers just from a pure practicality point of view.
Perfect. Okay, cool. Ciara, there's a question then of whether we would expect the CBI code might include some more specific guidance, and will there be some alignment between the Consumer Protection Code eventually and all this? Well, make it a little bit easier for people.
So I saw that question about the specific guidance, and my short answer is I don't expect it to be as explicit as telling us how to apply the proportionate test. I think they will probably use principles and give criteria to be considered, but they very much like the FCA, but not as prescriptive, but they very much kind of leave it up to the firm to interpret. So, I mean, I would, if I was in a chief compliance officer position, I'd start thinking about what that might mean for my firm based on my internal data, and be ready to comply with more prescription from the CBI if it comes. But the reality is they don't usually go into that level of prescription as part of their code. So probably best to take a cautious approach in expecting that to come. In terms of linking all of this up across the CPC, it is the obvious. It's the obvious solution if they're given enough time and they're equipped in their policy division to do that. I'd say they will look to do it, but there is a timing thing that will be important here in order to get the review of the CPC has been going on for some time. We don't really have a timeline as to when that consultation is going to come out. And so it will be important to get the guidance out to firms to meet the September 21 timeline as soon as possible. So with luck, you know, it will happen, but it may not.
Well, we'll not hold our breaths too long.
No.
Is that what you're saying? Yes.
Yeah.
Okay, cool. Again, we've a couple of similar questions around misrepresentation and what's the panel's thought on the meaning of negligent misrepresentation. So under the CIC, it applies where the customer has answered honestly and with reasonable care, but their answer involves negligent misrepresentation. Would a consumer that's taking reasonable care have answered negligently? I don't know how to. Edel, do you want to give your view on that one?
Yeah, I think it's definitely a challenge as to, you know, where you'll go between the three categories. And I suppose the innocent one is probably something that you'd imagine that if it's innocent from the consumer side, but it's not really material to the risk. So I don't think we'll classify too much into that category if we're planning to adjust the benefits under the contract. I do think negligent is the box where we're likely to class most things on the life side, at least. And one of the questions I was interested was raising the point about smoking, you know, and well, would non-disclosure of smoking be considered as fraudulent? Now, that was one that really brought it home to me, because I'm saying, really, if you're a 20 a day smoker and you say you're a non-smoker, well, that certainly falls into the category of the UK deliberate, and therefore you'd say, if our equivalent is fraudulent, it should go there, because it is more than negligent if you can't claim that you forgot if in the next half an hour you're going to do it. But are we more likely, just for the sake of practicality, to say that we just want to adjust the sum assured to whatever it should have been for the premium if they were a smoker, because it'll be so challenging to put it into that fraudulent box. So unfortunately, there's a lot of questions there, because it is the greyest of all the areas. So I have a feeling that we'll tend to see things clustered in that middle negligent box.
I think it's even interesting that the next question directly after that one asks it in the opposite direction, saying there's a view saying you could put that in the fraudulent category quite firmly. So it's clear there are different views out there in the market, and it's like it'll take legal advice and stuff to resolve that one. I don't know if Naoise, do you want to comment on something specific as that? I think you're on mute there. So.
Apologies. Yeah, I was just going to say that I think the breakdown between the three categories is quite testing. Like, even I'm looking at it with my legal hat on, and the innocent representation talks about taking reasonable care, whereas I would start getting generally, I would see where you possibly haven't taken reasonable care and are getting into the reckless type territory. That would typically bring you into your negligence type areas in other acts and other pieces of legislation. It's interesting that there's a definition of fraudulent misrepresentation in the Act, but not negligence. And I think that means that we're going back to kind of common law, case law principles as to what constitutes negligent if ultimately there was a challenge to categorization. So that again is kind of grey area for insurers to grapple with and deal with, and is a little bit unfortunate. But I think the use of some of the wording is not great between for the dividing lines. Again, if I've taken reasonable care, how am I then into a negligent type territory? It's quite tricky, I think.
Absolutely. There's a few more questions. I suppose there's one which I might post to both Adrian and Edel. I know neither of you are HOFs, but if you were a HOF, would you be changing your technical provisions following this new legislation? Like there was mention of changing claim settlement patterns, frequency, etc.
Personally, from my point of view, I don't think I would. If I was a head of actuarial, I just think it's too vague at the moment in terms of the impact, that are too uncertain at the moment in terms of the impact this will have. I think it's probably going to have more of an impact in terms of operational issues, in terms of underwriting and claims, whether the amount of, like, just when we were looking at it from an internal point of view, the amount of times we have repudiated liability on the basis of a non-disclosure or avoided a contract ab initio is minuscule. And I would say it's not something that happens that often. So a lot of these remedies, they're used sparingly enough, I think, in many cases. And I don't think it's going to open the floodgates or anything like that with regard to increased claims costs. What I will say, though, is that where there is some dispute, it makes that dispute potentially very protracted and very difficult to succeed from an insurer's perspective.
Yeah, I think I'd echo Adrian's sentiments. If you were going from a cold start where you did actually sort of fully void every case where there had been a minor non-disclosure, then yes, your technical provisions would change. But I think to a large extent, this is really just writing into law what had largely become common practice. So the extent of the additional claims may be, should hopefully be minor, if any. I do think on the expense side, there is likely to be more contention about a number of cases. And actually, Adrian brought up a good point in his talk originally when he was talking about the IBNR issue. If you have a large employer-sponsored risk scheme, where the employer goes into liquidation, there is the question of allowing for potential future claims, which you wouldn't have in the past. But again, that's likely to be kind of fairly small in the overall scheme of things.
Someone has just suggested on the Q&A around from the general insurance side whether there's an increase in the ENID loading being considered, or that, I don't know if Adrian, that's probably one option for insurers to look at, is it?
Yeah, I haven't heard anything that is going to be the case at the moment. So I'm not sure if it will be.
Okay, so there's a few little technical ones for you, Edel. There's one around the obligation of disclosure. So asking if there's been any changes to health. When does the obligation of asking when any change to health end? Is it a policy issue or policy start date?
And sorry, I saw that and I was wondering I think it's actually when you actually go on cover, because this issue would come up with mortgage protection. So you'll often underwrite the risk and the policy is sitting there, but the premiums don't start and the risk doesn't start until a number of months in the future. And there is an obligation in that case on the life assured to tell you about material changes up until the point of the first premium. So typically that's, I think, where it starts.
And then there's a question about alterations on the life side. So if someone converts or I think exercise a GIO or something like that, I think would that trigger the new requirements on the existing policy?
I think probably in a legal sense, no, because we get this issue when it comes to cross-border business. It's not viewed as a new contract, but as exercising an option under an existing contract. So it's still part of the original contract. But whilst we've had that debate, we've been less concerned because from the underwriting point of view, this will tend to happen. Typically it happens towards the end of the term of the first policy. So if you're 10, 15, 20 years down the line, on the life side in particular, the impact of any non-disclosure is likely to be relatively small. But given that we're probably talking about the claims practices in particular aligning over time, I think that may go away as an issue.
Cool. There's a comment around TCs being rewritten in plain English, and I suspect the answer to that is a simple yes. If your TCs aren't already in plain English, they should be. So.
Yeah. That's one that's close to my heart. And sorry, if the legal question, no, this does not require you to write your terms and conditions in plain English. But remember that the Act says, where there's a term in your contract that is ambiguous, it shall be determined in favour of the customer. And I think you've a lot better chance of avoiding that kind of issue if you write something in straightforward language that a customer will understand, and you're less likely to argue about it. So best practice.
Absolutely. I think there's also another one which I think the answer is going to be yes on, is saying, is there a grey area between obviously incorrect and the proposer being deliberately misleading? So I think that's going to be a case-by-case assessment, isn't it?
Resounding yes. Yeah.
Okay. Cool. So then we have two good questions, I think, to finalize on. So the first one is will the, in your opinion, what the Act was trying to achieve, will it achieve that? So I might ask Ciara, Adrian and Edel to comment on that. And then there's a question around whether this will grow trust in the industry. So Naoise, I don't know if you want to pick that one up as well, but if general thoughts just to finish off from each person on those two questions. Do you want to go first, Adrian?
Yeah. Will it change, will it serve its intended purpose? I would have to say it's possibly going to have some mixed results. I think it's going to have some unintended consequences. It certainly makes it more difficult to underwrite risks, strictly and arguably prudently, because your ability to rely on information previously provided and to apply strict conditions in relation to certain states of affairs that you're told exist. So that's been taken away. So that has a positive impact for an individual consumer, but whether the pricing and cost of those additional claims, if there are any, will essentially just be spread across the portfolio more broadly. So whether that was the original intention, I don't think so. I think some of the timelines certainly weren't helpful and potentially could be a bit of a barrier to entry to some international insurers. It certainly doesn't make it easy to underwrite and to write non-life business in Ireland with these new regulations. So and then the last bit is particularly like there's a massive market capacity issue with regard to public liability insurance. We've heard lots about that, and some of the requirements and things such as, you know, rights of third parties and things like that. Again, it's not going to help capacity issues that are there in the market. So I'm not sure overall it will help things for consumers, but definitely there are some positive aspects in there that I think are welcome for, as a consumer myself of insurance products. There are definitely some welcome aspects.
Thanks, Adrian. Ciara, do you want to take those two questions?
Sure thing. Yeah. So I do think it will have an impact that was intended per the Act. I think it provides a lot more prescription to an insurer as to where they should be focusing to ensure protection of the customer at various different life cycles, particularly at the point of sale, provision of information, and the claims process. I think it will over time make the buying experience or the purchasing experience slightly more seamless for the customer. I think it will certainly address some of the information asymmetry issues that the regulator has had. In conversations that I've had with the Consumer Protection Directorate in the Central Bank, the word transparency comes into almost every sentence. And so this goes to the heart of addressing that matter for them. When it's written and codified in a piece of legislation, it's a lot easier to enforce. It also addresses some of the challenges that firms, Edel mentioned and talked really nicely about how some firms are doing this as a matter of best practice anyway, but there are others who probably aren't taking the same approach or taking a varied approach. And this kind of levels the playing field for that. It ensures that there's more kind of competition and trust within the market for the consumer. And yeah, I think for the less sophisticated consumer, it will have an impact on the touch point that they have with the industry, and ultimately all of that goes towards trust. It won't fix issues overnight, but it does go a long way towards addressing some of the perceived weaknesses from a trust perspective.
Perfect. Edel, your final views on that?
Yeah, I think there are some good things in the Act, like particularly the requirements to ask specific questions and to only require of customers to answer specific questions. That's definitely a challenge for insurers, but I think that's been a bugbear of a lot of customers. And if we get that right and it becomes commonplace, it takes away, I think, a lot of this feeling that, you know, the insurer is trying to catch you out, let's say, because the clearer you can be, the more understandable it is that I answered the questions or I didn't, and that determines the outcome. And I do think the third party ability to look to the insurer, you know, when in the case of liquidation or death and so on, I do think, again, even though it doesn't come up all that often, it's something that just looks very unfair to the end consumers and doesn't do the reputation of the industry any good. So whilst there are some things in there that I think are confusingly worded, let us say, and will cause difficulties with interpretation as we work through it, there's definitely some good pieces there. And in terms of industry reputation, I think this has happened now, and we need to get behind it, and we need to say, you know, we may have niggles about how it was done, but we fully support the intentions of the Act, which are to act in a more open and transparent way with our consumers. And we, the insurance industry, need to get that message across that we are trying to do the best for our customers. And yeah, we don't always get it right, but we're trying to move in that direction, and that's got to help with our reputation.
Absolutely. Naoise, any final thoughts from you on those two questions?
Yeah, I think I'd echo what a lot of the previous speakers have said. I think it probably will go a long way to achieving its aims, but I suppose the aims of the Act were very customer focused, and rightly so in a lot of instances. So I think it will rebalance things in favor of the customer. I suppose in terms of trust and rebuilding that trust, I think ultimately if the developments and the progress are with additional costs and increased prices on the consumer, that's not going to do anything from a trust perspective with the consumer, and that's ultimately where a lot of their feelings regarding the insurance industry will come from. There has been a lot of negative attention through the BII insurance with the central bank and from the government, so trust is not at a high level. And while this might improve things, ultimately if customers are going to be paying more for policies, it'll be overall probably slightly negative, but I do think it will improve things in terms of those pieces, which is trying to improve the clarity for the consumer, what they have to do at renewal stage, pre-contractual stage. It should be beneficial.
Brilliant. Well, look, that was a really excellent session, and thank you for all your answers and the openness and sharing what you've been doing and what you're focusing on. I hope everyone attending found it really useful. We had over 100 people at one point, so I think it's a good audience, and there was lots of questions coming in. I think we could have ran for another hour if we had the time. So yeah, so it just leaves me to say thank you to our panelists. I think appreciate you putting your time and effort into this, as I said, and then thanks to Simeon and Catherine for doing all the coordinating and technical support in the background. And yeah, and then thank you all for attending. Yeah, so hope we speak to you again soon. Thanks, everyone.